So really what we're saying is that the behavior of a client or the behavior of an investor really has a strong correlation to the performance. Would the assumption then be that if you just listen to your advisor, you're fine?
You would hope, but you have to make sure that your advisor is sticking with the plan as well, because there are lots of times where advisors are going to make some kind of a change to the portfolio. And I think the biggest culprit of that is something that I call penalty kick syndrome. So, and when I've read different reports on this, some of the logistics behind the penalty kick in soccer is different depending on which study that I've looked at. But it's something like when the penalty kick is happening, the ball is going to be coming in so fast, the goalie essentially needs to decide, am I going to go to the right or left, or where am I going to go, just prior to the contact of the kicker actually hitting the ball, because everything's going to happen so fast. He's got such a big area to cover. And so what happens is, I think the last research that I saw, the goalie will make the save about 11% of the time if he moves to the right, about 12% of the time if he moves to the left, but something like 32% of the time if he stays in the middle. And when the researchers quantified all this data, they went back to the goalies and they said, hey, guess what? We found if you stand in the middle, you're actually going to almost triple the amount of time that you're making a save on this. And most goalies said, well, I can't do that. It's going to look like I froze and I didn't do anything. So I actually have to move. And so I think what can happen is when we go through periods of volatility, or someone's got low returns, or they see that their brother had high returns somewhere else, and they contact their advisor and say, hey, I just got my statement. I know we're going through some volatility. I saw some stuff in the news. I'm down 5%. We probably need to make some changes. What are we going to do? Well, suddenly, this is now the financial advisor. So hopefully the advisor knows that if he stays where you are, if it's a properly built portfolio, that is going to give you the best outcome. But most of the time that advisor is probably going to say, okay, well then let's move you to the sidelines where you think you're going to be safer, or let's change this investment or to here or there. So we've made changes now, but those changes, as the research shows again and again and again, are almost always not in a person's best interest. So what happened back in 2008, 2009, we had a very steep drop from, in the fall of 2008, and there were lots of people that would have pulled their money out here. Right? That drop happened so fast, it's down, people panic, and then this would have been the optimal re-entry point, way down in March of 2009. But if the media was telling people to be scared in October and November of 2008, the media was telling them they should be terrified in March of 2009. There was no all clear signal saying, hey, congratulations, we made it to the bottom, everything's good, it's just going to be one of the biggest 100-day runs we've seen in the markets in 100 years. So most money didn't actually get back in till here. So we're looking at a big portion of money that's lost. They would have been better if they had just been that goalie that stands in the middle and holds their ground. So when I also look at advisor behavior, I remember during that same period of time, one of the big banks started releasing reports basically saying, hey, you know what, we're very happy that even though we've got all this volatility, we're seeing net positive sales. So this report here, one of the presidents said, we have 680 million in net sales. Well, when you actually looked a little closer in the numbers, it was 1.1 billion that went into money market funds, essentially cash, and actually 433 million coming out of long-term funds. So these are people dealing with an advisor, but yet the bottom line showed that money was coming out of long-term funds and going into the sidelines. So right here, right at that bottom point, they were yanking money out and parking it in cash. This happened again in February. It happened again in March. And then I think the one when I saw this report that frustrated me the most, because almost in my opinion a duty of care was dropped here, was in April, where the same report came out and they said, look, we see strong demand by investors for a lot of our conservative products, and we introduced this brand new, very conservative portfolio, and a bunch of the new money that got invested this month went into there. So this was a situation someone was depending on their advisor, and the financial institution actually created a portfolio to deal with the fact that people were afraid. This was probably one of the single biggest investment opportunities I will ever see in my lifetime. And instead of the advisor saying, you need to hold your ground, you need to have an equity portion in your portfolio, this will improve, they said, that's fine, you want to do that? Let's put all of your money in the sideline over here, right in this area down there. One of the best investment opportunities we'll probably see in a generation, and money was getting piled into cash or bonds, missing that huge run that they were going to see in equity markets from that period of time. So I think if someone is going to have long-term financial success, if this money's for your retirement, if your retirement's going to be longer than 3 years, then you need to plan for it that way. And that's a very hard approach that we'll take with everyone that we work with. Say, look, you're going to need money in 5 and 10 and 15 and 20 years. Let's build this portfolio accordingly. And don't chase last year's rate of return. So whatever just happened over the last 12 months, don't follow that. If something dropped, then don't think that it's going to do that again. If you've built a plan based on your long-term goals and your risk tolerance, then you need to stick with that plan.